Welcome to the debate. Here on Breaking News to Trading Moves, we are looking at technical analysis, specifically whether studying past market data, like price and volume, can actually forecast future asset prices.
Right, and the central question we are tackling today is whether this technical analysis legitimately extracts excess returns by, capturing behavioral psychology and structural market inefficiencies, or, conversely, if it is just a psychological illusion.
Exactly. I argue that technical analysis, especially when viewed through the adaptive market hypothesis and enhanced by machine learning, provides a credible, measurable informational edge.
And I counter that technical analysis profits are just mirages. They are born from efficient market mechanics, statistical anomalies, and the psychological illusion of control.
So to frame my position, we really have to look at what technical analysis actually is at its core. Think about a doctor looking at an electrocardiogram.
Sure, the EKG.
Right. There is an expectation of precision there. The machine records a jagged line, and the cardiologist points to a specific spike to diagnose an arrhythmia. It is a direct measurement of a physical mechanism.
Well, yeah, because the data maps directly to an observable biological reality. It is clinical.
Exactly. But step onto a trading floor, look at a price chart, and that visual certainty becomes heavily contested. But it shouldn't be. Technical analysis is a systematic method for quantifying human mass psychology. I completely reject the notion that markets operate like perfect physics equations.
Oh, come on. No one thinks they are perfect physics equations.
While the hardcore efficient market proponents act like it. But I align with Andrew Lowe's adaptive markets hypothesis. This views financial markets as biological ecosystems. Different species of investors, like pension funds or retail traders, interact, adapt, and create recognizable trends.
I hear your ecosystem analogy, I really do, but I approach this from the efficient market hypothesis. The weak form specifically states that all historical data is already discounted in asset prices.
Instantly?
Yes, almost instantly. Intense competition among those exact investors you just mentioned forces all public information to be priced correctly. This leaves no room for excess returns based purely on past prices.
Even with modern computational power?
Especially with it, the apparent historical success of technical analysis is predominantly a product of data snooping and survivorship bias. If you test thousands of parameters, some will appear profitable purely by chance. These charts primarily offer an illusion of control.
Okay, but if that illusion of control is so prevalent, how do you explain the data coming out of recent computational models? We are not talking about a trader sketching resistance lines with a pencil anymore.
I know we're not using pencils, but the math is basically the same.
Not at all. Let us connect the dots with the comprehensive study of the Nifty 500 index. Researchers utilized machine learning, specifically neural networks and XGBoost, to filter traditional technical analysis buy signals.
Filtering how exactly? Because adding computational power does not automatically validate bad underlying inputs.
They fed the models 51 different attributes simultaneously. They looked at indicators like the relative strength index, which is, a speedometer telling you if an asset is overbought.
Right.
And Bollinger Bands, which are like dynamic leans on a highway. When researchers used a baseline technical strategy alone, the average profit per trade was around 3%.
Which is barely beating a simple buy and hold strategy.
Fair. But by applying an XGBoost model, they improved the average profit per trade to 4.6%.
Wait, really?
Yes, a 46% improvement over the baseline. The model proved highly capable of classifying trades into profitable or loss-making categories by analyzing complex interactions.
Okay, that improvement looks impressive in isolation, I will admit. But you are completely ignoring the overarching problem of data snooping here.
How is out-of-sample machine learning data snooping?
Let us look at the Sullivan, Timmerman, and White reality check study. They evaluated over 17,000 trading rules on the Dow Jones Industrial Average spanning a century of data.
A century is a long time to find patterns.
Exactly. Think about that mathematically. When you test 17,000 variations over a century, you are statistically guaranteed to find strategies that look like they generate massive profits.
But finding a working strategy in historical data is the entire point of backtesting, is it not?
Finding a working strategy is fine, but finding a statistical anomaly and mistaking it for a strategy is dangerous. They tested the Dow from 1897 to 1986 and then ran an out-of-sample period.
And the best rule was what? A volume strategy?
Yeah, a 2-day on-balance volume strategy. But then the researchers applied a bootstrap method to adjust for the effects of data snooping.
Okay, for the sake of clarity, walk us through how they applied that bootstrap method.
Sure. Imagine shuffling a massive deck of cards thousands of times. The bootstrap method resamples the market data over and over to calculate the probability that this winning rule emerged merely by chance.
And the predictive power vanished.
Completely vanished. Once they adjusted for the sheer volume of rules tested, the edge was gone. It proved that if you interrogate the data long enough, it will confess to anything.
I disagree that machine learning does the same thing.
It absolutely does. A neural network with multiple hidden layers can find a mathematical function to fit any set of random data points perfectly. It just overfits the training data.
Look, dismissing modern technical analysis because simple, decades-old moving averages failed in a broad backtest is, it is like dismissing modern medicine because putting leeches on a patient failed in the 18th century.
Leeches? Really?
Yes. You're comparing a magnifying glass to an electron microscope. The Sullivan study looked at simple mechanical rules in isolation. Advanced algorithms process dozens of attributes simultaneously.
I mean, an electron microscope looking at random noise still just sees random noise, right?
Well, it is not random noise. That is the whole point. Instead of just drawing straight lines, these advanced models look for phase space reconstructions.
Phase space reconstructions, that sounds like jargon to hide behind.
It is a mathematical way of mapping out all possible states of a market to find hidden, recurring loops that the human eye could never catch. A simple crossover might fail, but an algorithm detects the nuance.
I hear your point on the complexity of the algorithms. I really do. But markets are highly non-stationary. A pattern that an XGBoost model identifies today might rely on specific retail trading platforms that simply do not exist 5 years from now.
Which is why the models adapt.
But the efficient market hypothesis tells us that once a machine learning algorithm identifies a profitable inefficiency, capital floods into that specific trade. Arbitrage occurs, and the edge disappears almost instantly.
That assumes capital can move with zero friction, which brings us right back to why the adaptive markets hypothesis is the theoretical backbone here.
Right, the Amazon rainforest analogy.
Exactly. In a rainforest, you do not have perfect, sterile equilibrium. You have an ongoing evolutionary struggle with predator and prey dynamics. By taking an inventory of the constraints of different financial species, we can predict responses to external shocks.
Okay, give me a tangible example of how those species interact to create a predictable pattern on a chart.
Take a massive pension fund. It cannot liquidate its positions in a single day without crashing the asset's price.
Because of liquidity constraints, sure.
Right. It has strict fiduciary obligations and compliance rules. It must sell incrementally over weeks. On the other end, a high-frequency algorithmic trader can exit a position in milliseconds.
So they operate on completely different timelines.
Exactly. Technical analysis measures these structural reactions. When we see automated buying triggered at specific support levels, we are observing the behavior of a specific species of market participant. The patterns on the chart are simply the tracks left in the mud by these species.
I acknowledge behavioral biases and structural constraints exist, but the collective market reaction averages out to a rational price, creating a random walk.
A completely random walk?
Yes, the ecosystem metaphor implies predictable, isolated interactions, but financial markets have a massive aggregation effect. The actions of the pension fund, the retail trader, and the algorithm all collide, and the price represents all that combined information simultaneously.
I think that is overly reductive.
Well, if you're listening to this and looking at your own trading app right now, you might be wondering if those MACD histograms are actually helping you or just making you feel smart.
Are you saying the charts have zero psychological value to the person reading them?
Oh, quite the opposite. They have immense psychological value, but zero economic value. Look at the psychological trap outlined by the brokerage firm Zerota.
The visual complexity argument?
Exactly. A trader looking at a chart with multiple indicators experiences a cognitive illusion. The sheer visual complexity gives them a false sense of mastery. It is a psychological comfort blanket designed to make them feel they have control over a mercurial market.
It is much more than a comfort blanket. The patterns reflect genuine behavioral phenomena established by researchers like Tversky and Kahneman.
You mean like loss aversion?
Specifically loss aversion and reference dependence. When a stock price drops to a certain level and repeatedly bounces back, that is not an illusion. That is a measurable point where buying pressure overwhelms selling pressure. Market participants remember past prices.
But the brain naturally seeks out the familiar, even when it is not there. I compare those technical charts to Rorschach ink blots.
Ink blots? That is a bit harsh.
It is true. The human brain is hardwired to impose order onto completely random data sequences. You look at a chart and see a head and shoulders formation. Someone else looks at the exact same chart and sees statistical noise.
But that implies the patterns only exist in the mind of the beholder, which contradicts the empirical data we just talked about.
Research by Clyde and Osler on nonlinear prediction showed exactly that. People consistently find patterns in randomly generated simulated data, so traders are often just reading their own desire to find order in chaos.
But we actually have empirical data showing these patterns are not just random noise on a simulated chart.
The Nifty 500 study again?
Yes. It specifically tracked breakout resistance strategies. A resistance level is quite literally a price at which selling pressure exceeds buying momentum due to psychological selling points.
I know what a resistance level is, but
Let me finish the thought. When the price breaks above that resistance, it creates new highs. The decision tree models literally map this out, placing higher probabilities of profit on specific volatility and volume thresholds crossing simultaneously. This is not an ink blot. It is a quantified break in supply and demand.
okay, let me explain exactly how that break happens, because it actually proves my point. Let us look at the mechanics of pattern formation through the Santa Fe artificial stock market double auction models.
Oh, the simulated markets.
Yes, researchers created a closed artificial market with 512 boundedly rational agents.
Boundedly rational, meaning they operate with limited information and processing power, just like human traders.
Exactly. And these simulated agents were programmed with genetic algorithms to buy and sell. The researchers essentially allowed these trading strategies to evolve over time by killing off unprofitable rules and breeding the profitable ones.
Okay, so a pure Darwinian simulation.
Right. Crucially, when the agents were programmed to look for support and resistance lines to set their stop-loss orders, those exact visual formations appeared in this simulated price data.
Because the agents acted on them.
Yes, the pattern possesses no intrinsic economic value. It emerges solely because a critical mass of participants expect it to. It is the textbook definition of a self-fulfilling prophecy.
I see where you're going.
The breakout only happens because thousands of algorithms and human beings are programmed to buy the breakout.
That is a compelling argument. But have you considered that the origin of the pattern does not negate its utility?
How so?
Well, I accept the self-fulfilling nature of these patterns. But if a pattern reliably becomes a self-fulfilling prophecy, it is still a highly tradable, predictable inefficiency.
But it is not based on fundamentals.
It does not matter. If I know that a critical mass of traders will aggressively buy when a price crosses a specific threshold, it does not matter if their motivation is based on underlying economic reality or a shared hallucination. The price is going to move.
But capturing that move is where the strategy breaks down in practice.
Not necessarily. We can look at noisy, rational expectation models developed by researchers like Traynor and Ferguson. They show that historical prices help traders infer the private information of early actors.
Because the current price does not fully reveal everything?
Exactly. Due to noise, like unobserved supply or hidden liquidity, past prices combined with current prices give a better inference. The price chart is a footprint. Exploiting herd mentality is a valid, evidence-based strategy.
Except the strategy self-destructs the moment it becomes popular.
Not instantly.
Yes, instantly. If everyone knows the self-fulfilling prophecy is going to happen, the smart money anticipates it. They buy before the breakout. Then even smarter money buys before them. This process regresses until the pattern is entirely priced in.
So we are back to the efficient market hypothesis.
Exactly. As the market evolves, the lifespan of these self-fulfilling prophecies shrinks to nearly zero. The artificial market models show that the patterns emerge, but real-world data snooping studies show that actually profiting from them over the long term is nearly impossible.
I think this is a perfect place to crystallize our perspectives. I maintain that technical analysis, especially when processed through advanced machine learning and understood as a metric of ecosystem psychology, remains a robust tool.
And I stand by the evidence that it is largely an illusion.
Right. By recognizing markets as adaptive biological ecosystems rather than perfectly efficient machines, we can use historical data to navigate actual market mechanics. The data clearly shows that complex algorithms can indeed find actionable signals in the noise.
And I conclude that while technical analysis visually maps human behavior, rigorous statistical testing shows its predictive power is continuously neutralized by market efficiency.
The patterns we see are largely self-fulfilling prophecies.
Just a psychological comfort, in your view.
Yes, for the vast majority of participants, it serves as an illusion of control rather than a durable long-term edge.
Well, we certainly share an agreement that human psychology undeniably drives market movements. Where we have continued disagreement is on whether historical price data can reliably exploit that psychology before the market corrects itself.
Exactly. We invite the listener to review the material for themselves and continue exploring the complex intersection of behavioral finance and market efficiency.
Think back to the cardiologist and the electrocardiogram we discussed at the start. In medicine, the jagged line represents a mechanical truth of the human heart. In markets, the jagged line represents us, our fears, our constraints, and our collective expectations. Whether you can trade that line successfully remains the ultimate question.